In 2019, a Fortune 500 CEO approved a strategic expansion that erased $14 billion in shareholder value in under 18 months. Not because he was incompetent, because he was confident. Smart executives don't usually fail from ignorance. They fail from pattern blindness. The higher the IQ, the more dangerous the mistake. Here's the uncomfortable truth. Most catastrophic business decisions don't look stupid in the moment. They look inevitable. In the next few minutes, you'll see exactly why intelligent CEOs repeatedly walk into predictable disasters. We're breaking down 3 pressure points most leaders never see coming. First, the psychological distortion that grows with success. Second, the strategic trap hidden inside scaling. Third, the silent moment when smart risk becomes corporate suicide. By the end, you'll understand why some of the smartest people in business still drive billion-dollar collapses. Write this down now. Intelligence does not protect against structural blind spots. Let's open the file. Part 1. Success creates cognitive distortion. Every major corporate failure begins with a period of success. Always. Growth feels like proof. Profit feels like validation. Praise feels like accuracy. But success quietly rewires perception. This is called success bias, when past wins convince leaders their judgment is universally reliable. One-line explanation. When something works repeatedly, the brain stops questioning the method. Look at a common pattern. A CEO leads a company from $200 million to $2 billion in revenue over 6 years. Margins improve. Media praise increases. Board confidence rises. Internally, something dangerous happens. The leader stops asking, "Where could this break?" and starts assuming, "This will keep working." Confidence slowly replaces caution. Here's where most people miss it. The risk isn't arrogance. The risk is over-pattern recognition, seeing the future as a continuation of the past. And it gets worse. Part 2. The scaling trap. Scaling amplifies small strategic errors into catastrophic ones. At small size, mistakes are bruises. At scale, they become fractures. Smart CEOs understand growth mechanics. What they often underestimate is complexity explosion. Example: a company successfully dominates one market segment. Revenue climbs from $500 million to $3.5 billion. Market share hits 42%. Analysts call it unstoppable. The CEO makes the logical move. Expansion. New geographies. New product lines. New vertical integration. On paper, it looks disciplined. In reality, the risk surface just multiplied by 5. Here's the structural problem. Each new market adds regulatory exposure, operational variance, cultural friction, capital strain. But success-trained leaders often underestimate this nonlinear risk. Growth increases fragility. Write this down now. Scale magnifies hidden weaknesses. And this is where intelligent CEOs become vulnerable. Because the numbers still look good at first. Part 3. The moment of strategic overreach. Corporate disasters rarely begin with one reckless decision. They begin with a series of reasonable ones. This is what makes them so dangerous. Picture this. A CEO authorizes a $4.2 billion acquisition to accelerate synergy. Analysts initially approve. Stock bumps 6%. Press calls it bold. Internally, however, 3 stress fractures appear immediately. Integration complexity rises. Debt load tightens. Execution bandwidth thins. But here's the psychological trap. Once the commitment is public, reversal becomes politically expensive. This is escalation of commitment. One-line explanation. The more resources already invested, the harder leaders push forward, even when warning signs appear. And now the timeline accelerates. Quarter 1. Minor underperformance. Quarter 2. Temporary headwinds. Quarter 3. Guidance revision. By the time reality is undeniable, Billions are already exposed. Smart people double down. And here's the brutal part. Many CEOs see the risk. They just see it too late. Part 4. The collapse mechanics. When strategic mistakes finally surface, the fall is rarely gradual. It's sudden, violent, public. Market confidence evaporates first. A stock trading at $82 drops to $47 in 6 months. Institutional investors begin rotating out. Credit agencies revise outlook. Liquidity tightens. Now the same leverage that once accelerated growth begins compressing oxygen. Inside the company, psychology shifts fast. Executives become defensive. Communication slows. Decision cycles freeze. Externally, the narrative flips. Yesterday's visionary becomes today's cautionary tale. Markets forgive slowly, but punish instantly. And this is the part most people misunderstand. The CEO didn't suddenly become stupid. The system simply exposed the blind spot that success had been hiding. Smart CEOs don't fail because they lack intelligence. They fail because success quietly removes the friction that once protected them. Early in a career, mistakes hurt fast. Feedback is immediate. Reality is loud. At the top, signals arrive slower. And by the time they appear, the numbers are already enormous. If there is one lesson from every major corporate collapse, it's this. Complex systems don't reward confidence. They punish untested assumptions. Write this down. The smarter the leader, the more disciplined the doubt must be. Because in modern business, money isn't just lost, it's misjudged.